Hi, I'm Jeff Cait. For over 30 years, I've taught life insurance advisors how to optimize family benefits and sell with compassion over profits. And today I'm teaching you directly so you and your family can have peace of mind. Today we're talking about answering the question term or permanent life insurance. This is a heated debate in financial planning. Buy term and invest the difference. It's gospel in mainstream financial advice. That's what the loud majority says. And I admit people get stupid advice from all sides. Financial planners dismiss permanent, competes with their assets under management fees and how they get paid. And insurance advisors oversell permanent. They call term a waste, which it's not. So they're all playing this simple game without looking at math, maximizing their business objectives. The most common misconception permanent as instead of rather than in addition to. I work on the math to create clarity for allocation decisions so you don't have to. Here's a hint combination of both is clearly best in the vast majority of family situations. Just get the minimum permanent along with the term, then find a product specialist who specializes in optimizing the death benefit. I like to say, ask your dad what he thinks about life insurance. It's an attractive space for families who want to discuss these important emotional issues. Today, I'm going through 4 different sections showing you how it works under different scenarios. So I know it looks like a lot, but this should be our answer. This should be as simple as I can make it because everybody should see this. One page, the only page. And it answers the question how much should I allocate to life insurance? 45-year-old female non smoker, $4,000 a year for 20 years, $80,000 total over the 20-year period. Now I've highlighted the 4 sections. Here's just the convertible term portion. They got these combined values showing what the total would look like. Here's an explanation of why and the 3 components so you can break them down and understand. And this is what I teach professionals. This is the stuff that I ask them what they show to their customers. One and done product sale, 30-page insurance company illustration that you have to sign that you accept and understand it as part of the application process. I know it's a lot. I know this page is a lot, but it's worth it. It's just 1 page to learn, and you'll be an expert on product. Ask questions, and then after seeing the math, better position to decide how much based on your situation that you want to allocate to the life insurance. This is the term product. It works like cash does in a traditional investment portfolio. 45-year-old female showing today's annual cost for 20 years of layered term with Manulife shows both the estate value and the cash value, which is 0 because it's pure insurance. It's cash like in the portfolio because you get in, it's convertible, permanent without medical underwriting, keeps your powder dry until you decide if you want to allocate that much and you can get out. The lowest cost protection, cancel anytime. We layer it to maximize flexibility. It's not one and done term, it's layered term, which creates more flexibility and options. Multiple term layers, multiple decision points. This is an option for pure protection, just term, full stop, but it is convertible. $1,000 a year, total over 20 years, approximately $20,000. This covers income replacement, short term protection. But what about long term? That's what the next slides address. Everybody should get to see minimum permanent insurance option, both types before deciding if they wish to allocate any amount to either. So why go from $1,000 per year to $4,000 per year? And over 20 years, that's $20K term only, increasing to $80,000 to get some kind of minimum amount of permanent insurance. I say it's because hopefully a long-term family first allocation. I say families do it for the benefit of other family members. The math doesn't care. You might decide you want to care, but here's what it might do for you. And I highlighted it there. Why? Funeral, probate, legacy. The funeral, I don't know. Someone's going to pay 10, 20, $30,000 off in the future, maybe 100. Probate. First clause of your will. It says to pay all my just debts. Estate assets may be illiquid, house, RSP, business. Cash in the estate is sacrosanct, guarantees liquidity without forced asset sales. And then we say, hey, any amount of this allocation can become a legacy, what remains after the costs are paid. This is what long-term family first investment, not personal accumulation. The reason why you'd allocate a portion of family wealth to this, You're doing it for others. Think about it. Now, I want to show you, this is my sweetener slide. You might not see it when you see this, but we've put in 80,000. We're putting in 4,000 per year. That means that you've put in 4,000 in the first year. And if we look at the cash value, after putting in 4,000, if you cash out, you get back 810. It's low. Those who leave the pool are putting money back into the pool for others. Jump forward to year 5. You've put in 20, you get back 10. And it reminds me of a TFSA. If you invested 20,000 in a TFSA and then they gave you back 10, either you got the worst advisor, or maybe you picked the wrong investments, or they're ripping you off. At least in this case, we know what's happening. They have upfront costs, they have to recover them, and then any excess goes back into the pool. It's not a bug. They leave the pool, they put money back for those who stay. It's a feature. Anti-selection benefit for long-term holders. And the second sweetener I should point out is that it's all built around this sweetener for corporate situations. So when you flip over to the CDA column, and it's almost the whole estate value in the year of the years, if you're in a corporation, you can take assets and get them out tax-free. It's just such a wonderful sweetener for someone who has wealth in their corporation. And now I want to look at one other thing. And I think this is the most important point. This is the main point of how we plan around life insurance using a diversified portfolio approach. 3 components showed separately. We got convertible term, 1,000 a year, starts with $1 million of coverage, guaranteed cost, short term, cash-like flexibility. And the non-par, the middle column, 15, 14 per year, 100,000 coverage, guaranteed insurance costs, bond-like. And then finally, you have the last column, which I call par, very popular today. It's participating. We put the same amount of money in, and what happens? After 20 years, they're projecting, not guaranteeing, they're projecting 100,000 of coverage. They have limited guarantees, but if you base it on current assumptions, it's a real equity-like component that looks really good in the marketplace today. So the total 4,000, but it's all about year 20 and the options that exist in the future. So now the 45-year-old is now 65 after 20 years of contributions. What are her options? And as Peter Drucker is often quoted, the best way to predict the future is to create it. Now we've created something and we can convert some term. Look, the term, keep some, get rid of some, and then you move across. Cash values, take policy loans, continue building. The consumer can see what it costs and how they all compare. And based on the best evidence we have today, we get to discuss all options available in 20 years and use that as our milepost where we're looking for something that we actually target and can adjust for as we move forward as our circumstances change. That allows the customer to make an informed decision about allocation. If you want me to build one of these for you, I'm available. But we created this approach based on more than 30 years in this industry. It's so difficult today to know who to trust with your financial future. Advisors paid on commission. Advice can be compromised. Financial planners may be pushing investments. Insurance advisors oversell permanent. Both are likely optimizing for their own benefit. So we've solved the problem. Here's the math. We teach the product. What I teach professional brokers so consumers understand their options. The most common misconception, this word that says term or permanent, like it's instead of, rather than the correct words were in addition to. A combination clearly best in the vast majority of situations. My honest conclusion, don't allocate heavily compared to RRSPs and TFSAs. If you don't have sweeteners, it favors smaller allocations. Minimum shop for the final expense. But for wealthy, corporate, family-oriented, there's a bias for a portion of family wealth. Can't decide without knowing what it is and how it works and looking at the math and comparing it to other things. And how about when evaluating advisors? Compared to what? Do they show you the policy contract? Do they put it in writing? This separates advisors optimizing for themselves versus serving you. Think of RSP for retirement, TFSA for flexibility, and life insurance for funeral, probate, legacy. Figure it out yourself or delegate. At least know that it exists. This is Jeff Cait, and thank you for listening to me talk about this today. All the best.